Okay, friends, so continuing with the issue of capital in corporate accounting. So this is the last entry we did. Moving forward, assume that attorneys have helped another company, another company to incorporate. They have billed the company $5,000 for their services. They agree to accept, rather than cash, they agree to accept 4,000 shares of $1 par value common stock in payment of their bill. So they have invoiced the company for a payment of 5,000 against their services, and rather than accepting cash, they are accepting 4,000 shares of par value 1. It means impliedly there is a $1,000 premium, because the par value, the legal capital of 4,000 shares would be $4,000, whereas the invoice is of $5,000. So it means the implied value of $1,000 par share in the market is supposed to be 1.2. So this way we record an expense, which is the organization expense, because this is a sort of expense. The lawyers have helped the company incorporate, so this is an expense. We record it as an expense, as an organization expense. So it is a reduction in equity on one side. And then we increase the equity by the par value of legal capital 4,000, and we increase the equity by shares premium of 1,000. So don't go to the this placing over here, because it's not necessarily about the left hand side and right hand side in the accounting equation terms. You see all these three entries are on the right hand side. So by $5,000 the equity is decreasing, and then by $5,000 the equity is increasing. So this way the equation completes. Assume that another company, Athletic Research, is an existing publicly held organization. Its $5 par value share is actively traded on at $8 per share. So on the day on which this transaction is taking place, actually the market value of share is $8. So the company issues 10,000 shares of stock to acquire land recently advertised for sale at $90,000. But negotiated at $80,000. Prepare the accounting entry for this transaction. So our par value is $5. We have issued 10,000 shares. So the common stock or the ordinary shares premium is 50,000. Since the market value is 8, so there is a 3 rupee premium. So shares premium or additional paid in capital is 30,000. So this makes up the 80,000, which we have given as a consideration against purchase of land. So our land increases, which is an asset, on the left hand side, and our equity increases on the right hand side in the form of share capital, which is the common stock, and share premium, which is the additional paid in capital. So this is how we can record issue of shares not only against cash. Sometimes we issue shares against some services, against some buying some assets. Sometimes we take over some other companies, we acquire the assets of other companies and issue our shares. So this is the kind of entry we record at that point in time. Another presentation of the same. I think we had this slide earlier. Again, this slide doesn't relate to the previous example. So assume we have been, it relates to the example which we discussed in the last video. So the total issued capital is 2,000 shares. So 2,000 per $1 par value. So 2,000 is the ordinary share capital. So this is the balance sheet and shareholders equity part, right? And this is the shares premium, and this is the retained earnings. So total shareholders equity is 33,000. Now the important concept that we want to learn here is the book value per share. Or if somebody asks us, what is the value of your share from the balance sheet? The value of the share, par value, face value is ₹10. The issue price was something else, maybe ₹12. In this particular case, the par value is $1, and the issue price may be $1.2 or something, whatever it was at the time when the shares were issued, maybe 1 year earlier, 2 years earlier. But now there are retained earnings as well, plenty of retained earnings. So what is the per share value of my share from the balance sheet? So this is the total shareholders equity. If we divide it by number of shares, we get the per share value. So 33,000, if we divide this 33,000 by number of shares, just par value is $1, so number of there are 2,000. So our per share value comes out to be 16.5, I assume. So $16.5 per share is supposed to be my book value per share from the balance sheet value per share, book value per share, breakup value per share. It is also known as net asset value per share, because we know from the accounting equation concept that actually shareholders equity or owner's equity is asset minus liabilities. So asset minus liabilities is the net assets. So it means the net assets available to shareholders are $33,000 from the left hand side of the equation now, right? Asset minus liabilities. So this 33,000 divided by the number of shares is 16.5, which means that just for the sake of understanding, if the company liquidates today and all the assets are realized at their balance sheet values, then and all the liabilities are met off from the on the balance sheet values, then every shareholder will get $6.5. So that this is the money the shareholder will get. So this is the balance sheet value per share, book value per share, breakup value per share, net worth per share. And this is very important from the viewpoint of financial analysis, because if everything else remains constant, if the balance sheet truly reflects my assets values, and there is no accounting manipulation, there are no other ifs and buts, then in that particular case, ideally the market value should be close to 16.5 as well, because the balance sheet says that for every one share we have $16.5 in the company invested. It means the market value should also be around 16.5, the balance sheet based market value, right? So this is one of the key ratios, one of the benchmarks which some investors take into consideration while deciding which equity to invest and which to not. For example, when I started investments back in 1999, 1 year before the 21st century started, when I had some money in my savings. So out of the few key ratios that I used to shortlist the companies to invest, this was one of the key ratios. So because if a share is trading at $14 and its book value is 16.5, it means the share is actually undervalued. If it is trading at $20 and the book value is 16.5, it means actually in the market it is overvalued. Again, keep in mind, keeping all the other things constant. So this is a big if, keeping all the other things constant, because there are too many assumptions underlying assuming that 16.5 is really supposed to be the market value. So there are too many things. For example, one of the important things that we, being students of accounting, should be able to witness is that the balance sheet values are sometimes not reflective of the market value of assets. So for example, in my balance sheet, there my property, plant and equipment. If I am using cost model, not the revaluation model, then my property, plant and equipment will be reflected on the historical cost, not the market cost, not their replacement values. So these and some other kind of things will make this book value per share relatively less relevant for decision making purposes. But again, this is a good benchmark to start with. So by now we know there is a par value per share, there is an issue price per share, which can be different whenever we issue the share price. So keep in mind the market value is not the issue price, right? Issue price is only relevant when we issue some new shares, right? By new shares, we mean they are already authorized, but they are unissued. So we discussed the concept that there is authorized share capital, say 1 million shares we have authorized, but we have issued only 50,000 shares. So we have 950,000 shares unissued. So we can issue maybe in 2024 50,000 more shares. Then in 2026, maybe we issue 50,000 more shares or 100,000 more shares. So every time we issue a share, we come up with an IPO. There has to be an issue price, which is a function of many factors. Book value per share, breakup value per share, net asset value per share. So this is the concept we just discussed. This is the balance sheet value per share. So total shareholders equity divided by the number of shares, and the market value per share is actually specific to every day, but rather specific to every moment in time. So whenever the market is open, the market value keeps going up and down. And this is this market value at the end of the last reporting date, 31st December, for example, 30th June, for example, which is taken for the purpose of unrealized gain or unrealized loss in FVTPL and FVTOCI that we discussed in the investment chapter. So this is the market value of share. So market value of share keep fluctuating, but what we take market value for the purpose of accounting is the last trading price on the closing day. So if my closing reporting day, I am closing my period on 31st December, then the market value that I take for working out unrealized gain or unrealized loss is the 31st December trading day, if this is an active trading day, and the last trade made on that particular day. So hope this is clear. We'll continue in the next video with some more concepts. Thank you.